And welcome to The Bottom Line, where we break down some of the main business and economic stories of the day. From the 8th to the 17th of October, an International Monetary Fund delegation visited Poland for an annual consultation in the context of IMF Article 4. To tell us more about the significance of Article 4 and the details of the concluding statement, I'm joined by Geoff Gottlieb, Senior Resident Representative from the IMF Regional Office for Central, Eastern and Southeastern Europe. Good afternoon. Thank you very much for joining us in the studio.
Thank you for having me.
So, what are the most important recommendations emerging from the IMF mission's concluding remarks?
Well, so first of all, this was our annual Article 4 mission, where we visit Poland once a year. We do it in all of our 190 members. We do it once a year in order to assess both what has been happening in the economy, what we project to happen, and then what our key policy recommendations are. And so we really make recommendations in fiscal, monetary policy as the core of the report. And then we also look at the financial sector as well, and then concluding with some issues with respect to the growth model and climate, which we can go into.
Okay, and so Poland's growth model requires some adjustments by the looks of it to the new economic conditions that it finds itself in. What changes would you consider the most urgent and why?
Well, I think there's two. I mean, first of all, I think it's important to assess that, to point out that the past 3 decades have been extraordinarily successful in Poland. Incomes have increased 250%. Even just since 2019, incomes have increased 20%, which is the largest in Central and Eastern Europe. So we're in a backdrop of extreme success. And the question is really how that can continue. I think you could summarize the economic model, the growth model in Poland, as basically foreign direct investment into the export sector, taking advantage of access to the EU market. And in particular, what those firms have taken advantage of is the fact that the population is well educated and has been competitively priced. And I think one key change that has happened is that labor has gotten much more expensive in Poland. And that does raise some questions about the ability to continue to attract foreign direct investment. So we want wages to rise very much in Poland. The question is having that wage rise matched by productivity so that Poland doesn't lose out on competitiveness relative to other countries.
But the population is also aging by the looks of it, so the economy needs to adapt to that.
No, there's no question. I mean, aging is a challenge in Poland, like it is a challenge in many countries in the region, throughout Europe, and really much of the world outside of Africa. And there's various ways of dealing with that. I mean, we look at labor participation, particularly women in older age groups, trying to increase labor participation there. Better integration of immigrants is another strategy. And then finally, investing in labor-saving technology is another one. But there's no question that the demographics and maybe tighter immigration can put upward pressure on wages and put a challenge to the growth model.
The concluding remarks refer to structural reforms that have to be implemented. And I was wondering whether you could elaborate on which ones you would consider as the most pertinent.
Well, I think, again, the first thing is making sure that we complete the last mile on disinflation. So inflation has been a big challenge. So I think before going to the structural reforms, I'd really talk about the macro issues. So I think completing the last mile on disinflation, which is really in the hands of the central bank. The second is bringing the deficit down towards levels consistent with stabilizing debt. And then the third is really around issues related to the climate and moving away from such a coal-heavy mixture. But then the biggest issue in Poland, and the thing that all of us that work in macroeconomics focus on, is how to increase investment. Poland has a suspiciously low investment level, and that's going to be critical to raising Poland's productivity going forward.
Yes, deficit. Poland's fiscal structural plan, that's been a big topic here domestically, and it's something that you touch upon in the concluding remarks. There's mention of the fact that the full set of measures is yet to be identified, and I was wondering what that actually meant, whether that wasn't necessarily clear to the mission. There need to be more details that need to be presented, more progress needs to be made on that, more details need to be clarified. Can you elaborate on that?
No, sure. I mean, before specifically addressing that, I think it's important to take a step back. Poland has debt of 50% of GDP. That is not high. That is a good level, and that reflects responsible management and fast growth over the past decade. So I think Poland is starting from a very good place. Sometimes I notice in the conversation here, people either say that the debt is a disaster and there's going to be a crisis tomorrow. Other people say there's no problem and Poland can grow debt forever. Neither are correct. So I think it's important to have a balanced conversation about the fiscal going forward. Now, the second point I would really make is that the measures, the total amount of adjustment that the government is targeting over the next 4 years makes sense to us. So it seemed appropriately ambitious in order to not just meet the EC, the targets of the European Union, but also to stabilize debt around a reasonable level, around about 60% of GDP. I think there was two things that we would have emphasized more and what we're encouraging in our communications with the government. The first is we think there could be usefully more fiscal adjustment in the first year. A lot of it is backloaded, and right now we have high growth and we have a bit higher inflation, so doing more of the fiscal adjustment now makes economic sense. The second is identifying a bit more about how it's going to be done. That gives more people and investors more confidence that it will be done. And the government just didn't specify the second half of the measures. And in fairness, the European Union did not require that. But we think for purposes of credibility of the plan, there's an advantage to doing so.
Very interesting. In terms of the energy transition goals, because that's another very hot topic here, and obviously in the EU as well, you reference removing barriers to private investment in renewable energy. I was wondering whether you could tell us more about what barriers you thought were in the way of that.
No, sure. I mean, Poland has reduced carbon emissions since 1990 by 22%. And the government has just announced new targets, which are appropriately ambitious, which is to reduce by 50% since 1990 levels by 2030. So there is a correct identification of the overall problem and ambition. So that's very encouraging. But again, taking a step back, there is a puzzle. Poland, even though Poland has made progress, Poland has one of the most carbon-intensive economies in all of Europe. And meanwhile, global investment in Poland is very low, and there's enormous amounts of capital globally searching for green assets to invest in. Somebody in Poland's financial sector recently told me that it was easier to raise green financing than to know where to invest it in Poland. So the key point, it's regulations like the regulations around the wind farms onshore that could unlock access to this global pool of capital.
There are repeated references to the EU recovery funds as a catalyst to support investment, productivity, growth, recovery. All these terms are key, and obviously we've heard them very often in Mario Draghi's recent report. Is there perhaps concern or perhaps skepticism that Poland could perhaps end up depending on those funds a little bit too much rather than perhaps focusing on structural reforms that are so key?
I don't worry about that. In the near term, this is a fantastic opportunity for Poland to have this much. It's not just the EU structural funds and EU agricultural funds, it's also the RRF, which is the funds that are available between now and 2026. And the government has unlocked a very substantial portion of those. So at this point, the real priority is making sure to do all the milestones in order to unlock that funding and to use it correctly for things like the grid infrastructure that are critical in order to unlock private capital. But going forward, there's no question there is a need to increase investment in Poland. The capital stock and investment in Poland are still too low, and that's a big priority going forward.
We talk quite often about investment here on the show. What would your recommendations be for attracting more investment in Poland?
Right. So Poland is still a bank-dominated system, and credit to GDP is falling very sharply, credit to the private sector. And there are a number of headwinds, both on the demand side and on the supply side, that are pushing credit down. We mentioned a number of the issues in the report, and we'll be going into more in the full report in January. But I think we need to be looking at things like the credit holidays, which eat into the bank business model, as well as the looming legal risks around things like the Swiss franc and the Viron situation that all push up the needed capital in the system and push up the cost of capital for banks. So I think that's one set of issues. There's a second set of issues, which is all of the funding of firms outside of banks. So the opportunities around private equity and venture capital. And I know that this is a priority for the government as well ahead of the Polish presidency starting in January. So finding a way not just to rely on FDI, foreign direct investment into firms that are ultimately foreign brands, but also providing startup funding for Polish brands that are not yet at the level of attracting this capital. So making sure that private equity, including venture capital, can get to the young and more risky and more innovative part of the Polish economy.
The IMF's remarks appear to be very much in line with the Polish National Bank's monetary policy, which stands out to be very hawkish, especially when you compare them with the monetary policy in other with the other regional monetary policies in other Central and Eastern European countries. I wondered whether you could elaborate a little bit more on how the IMF sees that.
No, that's right. I mean, I think there's two key areas where we see things very similarly to the National Bank of Poland. I think the first is that currently interest rates are appropriately tight, by which means limit pressure that would push inflation to rise again due to demand. I think the second area where we see a lot of see things very similarly is that there really isn't scope right now to cut, because there really are a number of upward pressures on inflation in the context of a very tight labor market. I think the trickier part, and where it's less obvious that, it's less clear exactly what the answer is right now, is when there will be scope to cut next year. And I think this is not an exact science. You're taking in many different points of information to know when there is scope to ease. And I think there we would again emphasize a couple things. I mean, one, we expect inflation to peak quite far from the target, and we see a fair amount of uncertainty around the inflation process. So we emphasize seeing a bit of progress on actual inflation before easing, to push against an instinct to cut too soon with the risk of needing to reverse. So I think that's point number one. I think point number two is that if the budget deficit and the fiscal policy adjust faster, that may create more space for the central bank to ease.
Okay, Geoff, it's been great speaking to you. I'm afraid that's all we've got time for.
Okay, thank you for having me.
And that was Geoff Gottlieb from the IMF Regional Office here with me today on The Bottom Line. Thanks so much for joining us on Business Arena. I was your host, Marie Kato. Join us every weekday at 5 p.m. CET on TVP World. And for more regional business stories, follow us on X and on tvpworld.com. Coming up next, World Talks. Goodbye.